Chapter 1 Introduction. Definition and explanation of the Plowback Principle. The Plowback Principle, also known as the retention ratio or the plowback ratio, is an important concept in finance and investing. In simple terms, it refers to the proportion of a company's earnings that it chooses to reinvest back into the business, rather than distribute them to shareholders as dividends. When a company earns a profit, it has the option to either distribute the earnings to shareholders as dividends or retain them for reinvestment in the business. The decision on how much to retain and how much to distribute can have significant implications for the company's growth and future profitability. The plowback ratio is calculated by dividing the retained earnings by the net income of the company. If the notations used are RE for retained earnings and NE for net income, the formula for plowback ratio is plowback ratio equals RE, NE. It is often expressed as a percentage. The retained earnings are the accumulated earnings that have not been distributed as dividends over time. They serve as a source of funding for the company's future projects, research and development initiatives, expansion plans, acquisitions, and other investments that can contribute to its growth. A high plowback ratio indicates that the company is reinvesting a larger portion of its profits back into the business. This can suggest that the company has growth opportunities and is committed to expanding its operations, improving its products or services, or exploring new markets. By reinvesting earnings, companies can finance projects that create value, enhance competitiveness, and drive sustainable growth. On the other hand, a low plowback ratio implies that the company is distributing a significant portion of its earnings as dividends. This may be an indication that the company does not have many attractive investment opportunities at the moment, or that it wants to reward its shareholders through dividend payments. Additionally, a low plowback ratio can also suggest that the company prefers to maintain a more conservative financial stance or pay down debt. The plowback principle has important implications for shareholders. When a company retains its earnings for reinvestment, it can potentially generate higher future profits and increase the value of the business. This, in turn, can lead to capital appreciation of shares and potentially higher returns for shareholders in the long run. On the other hand, when a company distributes a significant portion of its profits as dividends, shareholders can enjoy immediate cash returns but may miss out on the potential growth and value creation. Analysts and investors often evaluate a company's plowback rate.
Sample complete. Ready to continue?